Good morning and welcome to the Pensionmark Retirement Group 2012 Retirement Plan Educational Webinar Series. My name is Devin Duax. I'm the Vice President, Client Relations at Pensionmark, and I will be your host for today's webinar, The ERISA Requirement to Ensure Fees Are Reasonable, sponsored by Putnam Investments and Goldman Sachs. I would like to take a moment to mention a few housekeeping items. To ensure a quality webinar experience for everybody listening, your phone line will be on mute during the entire presentation. If you have any questions, please feel free to write the question in your text box on your computer and forward those questions to my attention, and you can do that during the presentation at any time. At the end of the presentation, we will take a brief question and answer session during the remaining time to answer any of the questions that you send during the presentation. Additionally, the webinar is being recorded and will be available on the new Education Center on the Pensionmark website, scheduled for release in Q2 of 2012, which we're very excited about. That being said, I would like to take a moment to introduce our special guest speaker, Tom Kmack, CEO and co-founder of Fiduciary Benchmarks, founded in 2007. Fiduciary Benchmarks is a benchmarking service for defined contribution plans. It's designed to help fiduciaries determine whether the fees they pay to their service providers are reasonable in relation to the value being received. Prior to founding Fiduciary Benchmarks, Tom started the J.P. Morgan Retirement Plan Services business in 1990 with American Century. Upon leaving in October 2007, that business employed 1,100 people, serving 200 large plan sponsors with over 1.5 million participants and more than $115 billion in assets. During his 18 years with Retirement Plan Service, Tom also served on the executive committee for J.P. Morgan's asset management business. Named by Ingram's magazine as one of Kansas City's inaugural class of 40 most influential people under 40. Tom is a recognized expert in the retirement services industry who has been a featured speaker at various conferences and has published articles in some of the most well-known periodicals in the industry. On behalf of all of us participating, thank you, Tom, for being with us today.
Well, thank you, Devin, and thank you to all the attendees on the phone, and thank you as well to Putnam and Goldman Sachs for allowing us to make this presentation with Pensionmark today. So with that, I believe I have the controls, correct, Devin?
Yes.
Great. So we're going to cover then today, let me see here. We're going to cover today 4 items. A little bit of background on being an ERISA fiduciary, which I think is quite helpful to most folks, even myself, having been in the business a long time. It's good to go back and look at what the requirements are for being a fiduciary. Secondly, we're going to take a look at the regulations related to fee disclosures, and most specifically, the regulation under 482. And then thirdly, while there is a bunch of disclosures going on in the industry, we're going to quickly see that the main issue is not disclosure, but it is fee reasonableness. And then fourthly, if indeed you have to determine fee reasonableness, what are your options for doing that? Because there are a number of those in the marketplace. So on the next slide, who is a fiduciary? Well, a fiduciary is anybody that has discretion in administering and managing a plan or controlling a plan's assets. And every plan has at least one fiduciary. Typically, they're the named fiduciary in the plan document. And for some, it's an administrative committee or a company's board of directors. So a lot of people ask, well, am I a fiduciary? The first question that we always get is, and then the answer that we give is, well, you need to refer to the plan document to figure out exactly who the named fiduciary is. Okay. Next slide, please. Really. Now, plan's fiduciaries will ordinarily include the trustee, the investment advisors, and anybody else exercising discretion in administration of the plan. And attorneys, accountants, and actuaries generally are not fiduciaries. They're basically carved out specifically in the law when they act solely in their professional capacities as attorneys, accountants, or actuaries. So first question, who's a fiduciary? Pretty simple. The named fiduciary in the plan, plus the trustee, plus the investment advisors, and anybody that's controlling plan assets. But it typically will exclude the professional services individuals. Next. So what are the duties of a fiduciary? Well, basically, this is outlined real clearly in Section 404A of ERISA. And they basically require 5 different items. 1, you must act solely in the interest of participants and their beneficiaries with the exclusive purpose of providing benefits, also known as the exclusive purpose rule. You have to carry out your duties prudently. You have to make sure that you follow the plan documents, that you diversify plan investments. And finally, there's a very specific clause for paying only reasonable plan expenses. And the law is very, very certain that they use the word, there's a definite reason why they use reasonable versus the word low. They want you to make a decision as a fiduciary whether or not the fees you're paying are worth the services you're receiving. So indeed, this is not a new requirement that fees be reasonable. It's been in the law for a very long time. It's one of the fundamental tenets of a fiduciary. And there's just more and more attention that's been put on it lately. Next. So what are the duties of a fiduciary? Well, first of all, the Department of Labor clearly recognizes that a lot of people that sponsor retirement plans are not retirement plan experts. They have other businesses that they're trying to run and things that they're trying to get done every single day. And so they clearly acknowledge that if they don't have the expertise to do certain things, they can hire someone that has that professional knowledge. And so it's very, very wise to hire experts like the folks at Pensionmark that clearly understand retirement plans. They understand how to benchmark retirement plans, how to help you monitor investments. And in fact, they encourage you to strongly do that. But another thing that a fiduciary should do when you take a look at it is that you have to document the decisions and the basis for those decisions. You know, I remember somebody telling me once when I first entered this business a long, long time ago that being a good fiduciary is much more about a process than it is a result. And you want to make sure that your decisions are defensible. So having good documentation in the file, making sure whether that's on benchmarking, whether that's on investment standards, whether that's on decisions that you made to maybe approve or deny a hardship withdrawal. It's really important to have documentation in the file. Next, please. Okay. Fiduciaries who do not follow the basic standards may be personally liable to restore any losses to the plan. So anytime I see the words personally liable, I get greatly interested. And one way fiduciaries can demonstrate that they've carried out their responsibilities by, again, documenting the process. And you can reduce some of the liability by delegating these things. And you've seen people, they've given fiduciaries the capability to delegate certain duties like 404C protection that comes along with delegating to participants the ability to direct their own investments. So the fiduciary has taken that duty for directing investments off of their shoulders. They've placed it onto the shoulders of participants. As long as they follow the 404C rules, they don't have any fiduciary liability if they've properly delegated those, for delegating those responsibilities. The same with auto enrollment into a qualified deferred investment alternative. The same with hiring service providers. If you hire a service provider to be the investment fiduciary for the plan. You still have the responsibility as a fiduciary for monitoring those providers or any of those delegation decisions you've made. But again, I think it's important to understand that there is risk associated with being a fiduciary. You can be personally liable, which is why you want to make sure that you document. And if you do delegate, making sure that the people that you delegate to, that you monitor how well they're doing. Okay. All fiduciaries have potential liability for the actions of other co-fiduciaries. This is something that a lot of people don't understand. So, for example, if one fiduciary knows that another fiduciary for the plan, let's say a money manager knows that the trustee has done something wrong, or the trustee knows that somebody else who has discretion and control of the assets has done something wrong, even though they're not the person that did that wrong thing, they are also could be held liable. So that's an important point to know. And if we're running a plan, it's very, very important to know that there's a potential liability for actions of other co-fiduciaries if you knowingly know of the breach, or you try to conceal the breach, or don't try to correct it. So that's another important thing to know. And that you know, as the graphic shows, knowledge is important, and you can't claim ignorance of the fact that you didn't help participate in the breach. Another important point that was on the Department of Labor website for fiduciaries is you must be covered by a fidelity bond. People who handle the actual assets for the plan have to be insured by a fidelity bond to make sure that if something does happen with plan assets that's inappropriate, that indeed the insurance will restore those assets to the plan so participants are made whole. So, you know, we wanted to take the first few minutes of the presentation today to talk about some of the fiduciary background. It's a term that's thrown about quite often. But, you know, as we look through the Department of Labor website that has all this actual, in effect, the Department of Labor publishing on their own website the most important duties for being a fiduciary, here's the big ideas. Number one, a fiduciary is someone who has discretion in administering and managing a plan or controlling the plan's assets. Typically, the fiduciary is named as the named fiduciary in the plan document. Other fiduciaries could include the trustee and investment advisors, like Pensionmark. But it's also important to note that attorneys, accountants, and actuaries are generally not fiduciaries, those folks who act in a professional services capacity only. And the key fiduciary duties are basically acting solely in the interest of participants and beneficiaries, known as the exclusive purpose role, carrying out all those duties prudently. And again, if you can't prudently carry them out as an expert, you can hire experts to help you. Following the plan documents, making sure that you diversify plan investments, and again, key emphasis, paying only reasonable plan expenses. Fiduciaries may be personally liable to the plan as a result of their acts or inactions, and fiduciaries can protect themselves by documenting and delegating, as we've already mentioned. And you can be held liable if they know of improper actions of other fiduciaries, and you should have a fidelity bond for those who handle plan assets. So, I mean, we basically put down 9 key ideas for being a fiduciary, and if you sort of follow these, you'll be in pretty good shape. So now let's move to the next part, which is what are the regulations related to fee disclosures? Well, there's actually, interestingly enough, been 3 key regulations. The Form 5500 Schedule C has been issued, and it requires service providers to put certain information on these government forms that they think will help bring more information to light for fiduciaries. There's been 482 regulations for plan sponsor disclosure, which goes into effect July 1. And then slightly after that, there are some 404A5 regulations for participant disclosure. We're going to spend our time today really concentrating on the 482 regulation. Now, you know, the past presidential debates have been so interesting on the Republican side to watch them constantly howl about the burdensome regulations put on America by the government. And so I thought it might be interesting to just spend some time to talk about, well, what does a regulation look like? Well, the 482 regulation has about 109 pages in total. There are 69 pages of just purely comments that the Department of Labor analyzed from about 50 comment letters that they received from folks like key record keepers or key lobbying groups, or sometimes an individual named Mark will just submit a comment with not much attached to it. So there's 69 pages of comments that said, hey, look, we issued a preliminary regulation. People said X. Here's what we think about a response to X. Then there's 18 pages of regulatory impact analysis where they basically say, okay, this is how much we think this regulation is going to cost the industry, and here's the benefits that result of it. But the actual regulation itself is only about 22 pages. So even though there's 109 pages to read in total, and you know I've read them those 109 pages front to back a number of times, the regulation itself is only 22 pages. But the Department of Labor does the absolute best they can to make sure that they hear what people have to say, and then they consider and weigh it carefully and sort of thumbs up or thumbs down, agree to change the regulation or not. So the 45 comment letters to the DOL basically led, oops, sorry about that, let's go backwards one. The 45 comment letters to the Department of Labor basically confirmed or changed the following. One, what's a covered plan? So they want to say which type of plans are covered under the law. Who's a covered service provider? Who actually has to make disclosures to the fiduciary? And when they make those disclosures, what do they need to talk about? And basically, if you think of services and status and compensation, those are the 3 big things. You know, what are you getting? What type of fiduciary liability are you assuming? And what are you getting paid? Now, they want to talk about the manner
seems we have a quick little interruption here. I'm working on the phone line with Tom. If everyone could just hold for 1 minute.
I'm sorry, I'm back in. Sorry about that, Deb.
Okay, thanks, Tom.
Apology. Technology.
That's all right.
So you can see here that I basically left off on the guide to initial disclosures. They talk about the timing. When do these disclosures have to be submitted? And then there's other things for what if there's an error in the disclosure, and what are the definitions, and state law, and all sorts of other things. But they carefully consider all the comment letters. So when they looked at the regulatory impact, okay, what does that look like? Well, it has to be reviewed by something called the Office of Management and Budget if it has an impact more than $100 million. And they basically thought the benefits would be reducing search time and costs for fiduciaries to identify the relevant fee and compensation data. They wanted to discourage harmful conflicts, reduce information gaps, and increase the department's ability to redress abuses committed by service providers. So they listed 3 big benefits. They didn't actually quantify the benefits. They pretty much thought that the cost, though, which they did have to quantify, would be a cost of $164 million in 2012 and $502 million through 2021. So when people talk about regulations, well, the government actually has to go through and sort of say, this is what it's going to cost to do this, and here are the benefits. In this case, they pretty much said they were convinced the benefits would outweigh the costs. And when we go to the actual regulation itself, as you read it, it's sort of funny. It reminds me of a saying by Rudyard Kipling that any great story starts with 5 W's and H. I keep 6 hunting servicemen. They tell me all I do. Their names are what and why and when and how and where and who. And so when you actually take a look on the next page of what the regulation is trying to do, it's really sorted in that manner. The first part, let's start with why. The Department of Fiduciaries need this info to satisfy their fiduciary obligations under ERISA Section 404A1A to act prudently and defray reasonable expenses. So again, this goes back to that core fiduciary requirement of, okay, this is disclosure, but the real purpose isn't disclosure. The purpose is reasonableness, and that's why you use people like Pensionmark to help you figure out how to do that. The number of times that reasonableness or reasonable is mentioned in the regulation is 49 times. So, you know, as I'm fond of saying, disclosure is just the beginning. It's not the end. Really, what the Department of Labor is really concerned with is the actual regulation, helping folks assess fee reasonableness. That's the why. The who, covered plans basically include qualified plans, but exclude SEPs, simple IRAs, individual account plans basically. And so covered plan has to make sure that they're acting in accordance with these regulations. And covered service providers is someone who expects to receive $1,000 more from the plan, directly or indirectly, as services as a fiduciary record keeper or brokerage. Note that registered investment advisors are covered service providers, and broker-dealers are covered service providers. So as long as that covered service provider is expected to receive $1,000 or more over the life of the contract, not in any 1 year, but over the life of the contract, they're expected to provide this disclosure to the named fiduciaries, so the named fiduciaries can then actually try to determine fee reasonableness. There's no set form for the disclosure. As I've said before, the 3 big ideas here are really looking at the services that are being provided to you, the fiduciary status that's being assumed, if any, by the entity, as well as the compensation, both direct and indirect. They're trying to understand conflicts of interest between related parties, so they want to understand that. And they also understand the compensation for terminating the agreement. So what's in the disclosure is services status and compensation, basically, including the unbundling of record-keeping compensation. So years ago, you know, there were certain record keepers that would say, well, we can't unbundle the compensation that we pay for record-keeping from money management. Well, the Department of Labor is requiring those folks to unbundle that compensation now and sort of make estimates as to what's being paid, what part of the fee is being used for record-keeping and what part of the fee is being used for money management. Now, how is the next part of the regulation, And there's no specific services that are requested to be disclosed, so the covered service provider has great latitude to say these are the services I'm providing to you. The status as a fiduciary or RRA is required to be disclosed on the form. The compensation is basically from annual operating expense. In addition to that, on top of the annual operating expense, you get to combine those two. The first regulation made you separate them out. The final regulation made you put them together. And then for each investment option, and this is a new component of the regulation, they also have to find out, you also have to provide the fiduciary the exact information related to those investment options, the name of the alternative, the type of investment, performance data, benchmarks, fee and expense information, or you can refer to websites where you can get that information. And then also how the compensation will be received. And again, a big change was a guide for finding this information. And they've also reserved comments coming forward for, is there a simple model disclosure that they could adopt for everyone like they've done on the participant side. I personally don't think model disclosure will ever come to be, because there's just so many different ways that arrangements are put together, bundled, unbundled, local TPA, not a local TPA, because there's such a variation in the way service arrangements exist in the retirement industry, which is all good for competition. It's going to be relatively difficult for them to come up with one standard disclosure that I think fits every one of those arrangements. Now, the regulation, as I said, is effective July 1, 2012 for all existing contracts. And subsequent new disclosures have to be provided reasonably in advance of the date of the contract. And there are a number of commenters that's asked for more information on what is reasonable, and in fact, they didn't provide any guidance on that. They just said the fiduciaries and the service providers will have to determine what reasonable is. For investment options, when do they have to be provided? Well, if you don't hold any plan assets at the time a contract is entered into, it'd be as practical, but not later than 30 days from the date on which the investment would start to hold plan assets. So, for example, let's say you had 15 investment options in a plan. 2 of them are brand new. They hold no assets today. And so you really don't have to make the disclosure on the investment options for the 2 that don't have any assets. But if subsequent to that, say 30 days down the road, that they did start to hold plan assets, you would have to make that disclosure 30 days from the date on which you knew that they held plan assets, which would conceivably be the date that they were deposited into the account. Again, for new investment options, as soon as practical, but not later than the date the investment alternative designated by the covered plan. So the Department of Labor is trying to be reasonable here, reasonably in advance of the contracts, as soon as practicable. But make no mistake, when the assets start to hold, when the investment options start to hold assets, they want to make sure that the fiduciaries are getting these disclosures. Now, major changes in the service and status of the overall compensation arrangement, not later than 60 days from the date of the change. They realize that there will be changes to these fee and service arrangements throughout. And one of the commenters basically said, look, changes happen every month on certain funds because of the way that sub-transfer fees work, and very, very small nuances in the way an expense ratio is calculated in a mutual fund. And so the Department of Labor agreed with those commenters, and they said, hey, look, if there's a major change in the service or status of the compensation arrangement, you've got to do that no later than 60 days from the date of the change. So 60 days after the date of the change has to be provided. But for compensation from investments, you don't have to make those disclosures only once a year. So I think all the service providers will be giving you a once-a-year disclosure on adjustments to the investment options. So, the big idea is July 1, 2012, reasonably advanced for new contracts, as soon as practicable for new investment options. If there's a major change in service or status, 60 days from the date of the change, and for compensation from investments annually. So it's not just one date. It's things that have to be monitored going forward on a number of different issues, which makes it difficult. There's also, though, some protection put in the regulations specifically for the named fiduciaries, for the people who are supposed to be receiving these disclosures. And it's an exemption that exists from the prohibited transaction rules if a covered service provider, what's known as a CSP, fails to make the required disclosures. So let's say a covered service provider doesn't give you this disclosure. The exemption to the named fiduciary is, look, you're not responsible for that. But once you discover the fact that the service provider hasn't given you the disclosure, you have to do certain things. First thing you have to do is you have to request from the covered service provider, the vendor, this is what needs to be done. And if they fail to comply within 90 days, the fiduciary must report the covered service provider to the Department of Labor. And there's 9 items of information that you have to do that. And the notice has to be provided to the Department of Labor no later than 30 days after the CSP refused to give you the information or the expiration of the 90-day period. So basically 4 months. So the big idea here is you're the fiduciary. You're expecting a disclosure from somebody. They don't give it to you. You now are required to ask them for it. If they still refuse, you have to go tell the Department of Labor 30 days after they refuse, no later than 30 days. I don't think that's going to happen very often because it's, as you can see in the very last bullet point, it's pretty severe if the covered service provider doesn't provide the disclosure. You need to terminate the agreement with that covered service provider. So, you know, the broker-dealers and the RIAs and the keepers and the TPAs, and they're all working very hard to give you these disclosures. But note that if you're not getting one that you think you should get, you need to do something about it as a fiduciary, because otherwise you have to terminate that arrangement because you can't determine fee reasonableness. So this is a big deal. Now, we talked about the background on being a ERISA fiduciary and all the things that came out of the regulation regarding fee disclosures. But now let's move on to the next issue. As I said before, disclosure is the beginning. It's not the end. The real determination is reasonableness. So on the next slide, I think, you know, since baseball season is about to begin, we're about, you know, 3 innings through a 9-inning baseball game. There was a huge desire for transparency in our industry on this issue. Even though it's always been a legal requirement, service providers didn't have to disclose some of these things. So the government, as we just covered, issued 3 new disclosure regulations, 482 being the emphasis today. And those disclosures are designed to assess reasonableness. But I will contend to you strongly, having been in this business for a long time, that you cannot assess reasonableness without looking at value. To get to the sort of example here is, if I told you I paid $30,000 for a brand new automobile and it's a 1985 Yugo GV Plus, you know, you're very quickly able to say the value for that is not worth the reasonableness of the fees. I mean, you know, Pensionmark is an incredibly well-respected, great investment advisor. And so, you know, the value that they provide should always be juxtaposed to those fees. It's not simply as in soybeans where you're just worried about cost per metric ton. So we're about, you know, 3 innings, 4 innings to an inning baseball game where these disclosures are going to start to come out and people are going to start to assess reasonableness. And as a result of that, they're going to start to look at the value side of the equation, because fees without value is a relatively meaningless exercise. In fact, that's why the Department of Labor requires in their 482 disclosures that services be disclosed, that fiduciary status be disclosed. To give you some idea of how important the Department of Labor thinks reasonable fees are, here's a couple examples for, they're very, very concerned always about how this impacts participants. So here are 2 individuals, Rob and Bob. You can see they're the same age. They make contributions for the same number of years. They both retire at 67. They're contributing about $2,000 a year with a 50-cent match. And they're earning about 6.09% of their money. But Rob is in an institutional class at 50 basis points, and Bob's invested in a retail class at 100 basis points. So who's going to have more money at age 65, Rob or Bob? Again, everything is the same except Rob's paying a lower fee. Well, you can see on the next page, obviously, Rob. And this is almost pretty close to the type of example that the Department of Labor likes to put on their website. They're very concerned about participants being overcharged. And they want to make sure that the fees are reasonable. To point out that indeed it can make a 6-figure difference in someone's account balance. And so that's a great example. But, next page, as it loads, the Department of Labor is stating again clearly that fees aren't everything. I always like to read this quote verbatim. In effect, it can be reasonable to pay higher fees if a plan is receiving more or higher quality services, or is attaining higher success measures than similar plans. In other words, the Department of Labor realized that determining fee reasonableness is a lot more difficult than just doing second-grade mathematics, where you learn that 1 is less than 2, and 2 is less than 3, and 3 is less than 4, et cetera, et cetera. They want you to balance the value that you're receiving for the fees that you're paying. To give you a further example of this on the next page, you're going to see very strongly that while fees are important, they're not the all-determining method of what needs to be done. So if you take a look here, on the left-hand side, our assumptions for a $40,000 employee that the actuaries say should replace about 82% of their pre-retirement income to have a wage replacement that's comfortable, so that they achieve a good retirement. So you don't need 100% for a number of different reasons. Taxes are lower, you don't make contributions, you don't have work-related expenses. So the actuaries basically go through the calculation. They go, hey, a $40,000 employee needs about 82% of their retirement income to live well. And you can see the assumptions on the left-hand side that we did. And you can sort of see how we calculated the 87%. The final monthly pay winds up being about $67.76. 82% of that is $55.56. Social Security projected forward for this individual is going to give them about $3,400 a month. The final account balance transformed into annuity is $1,370. And so they're going to have $48.60 when they need about $55.56. So since they're going to have 72% of pay and they need 82, 72 divided by 82 is about 87%. So that's their retirement readiness ratio. Now, what we did on the next page is we did a sensitivity analysis to show the impact on the retirement readiness ratio of 6 major retirement assumptions, changing them all by 20%, except early retirement, because you can't retire any earlier than 62 and receive Social Security benefits. So what I wanted to show here, and I think this is why the Department of Labor clearly emphasizes that you can't look at fees without looking at value, is if people retire early, 5 years earlier, their retirement readiness ratio is going to go down by 26%. And in fact, you see more and more studies of people saying, I'm going to work longer, I'm going to work longer. Because when you retire early, 3 things happen. Number 1, you stop making contributions. Number 2, you start taking money out of your account sooner. And number 3, Social Security is reduced. And in this case, when you retire early, 5 years early, Social Security is reduced by 30%. So that has a 26% negative impact, it's red, on the retirement readiness ratio. In addition, though, if this individual had started contributing at age 34 instead of 42, it would have gone up a full 16%. If, working with Pensionmark, you make sure that your investment options are as solid as possible, your rate of return goes up 20% from 7.11 to 8.53. That takes the retirement readiness up 6%. Again, another 20% increase. Let's increase the deferral by 20% from 6 to 7.2. Goes up by 4%. Let's increase the match by 20% from 50% to 60%. Goes up by 2%. And if you get the fees by a full 20%, the average fee being in the industry somewhere around 72 basis points, according to the Investment Company Institute, and other data that we've seen as well at fiduciary benchmarks, you have a fee that actually adds only 1 percentage point to the retirement readiness ratio. And the reason we put these slides up here quite specifically is for that one issue alone. This is why the Department of Labor wants to make sure that you don't just look at fees without looking at value. You have to look at how well your providers are helping your participants prepare for retirement. What services are they providing you? What fiduciary status are they assuming? Again, fees without value is meaningless. On this next page, we'll sort of give you the same indication of this, but we're just going to turn that same example into dollar amount. So you see in the red circle here that if we increase the deferral from 6% to 7.2%, the baseline calculation for this individual was $286,000. The revised dollars are $324,000. So an absolute difference of $38,000 for that individual. So if you had, I don't know, 500 people in your plan, you're talking about increasing the projected retirement balances by about $19 million. And in fact, every major lawsuit that's been filed regarding fees have talked about the impact that higher fees have on balances. And so by logic, a plan sponsor going for lower fees, but choosing a provider that results in actually lower balances could also, in my mind, have liability. And again, that's why the deal clearly recognizes and emphasizes fees reasonable versus low fees. There's a very specific reason they chose the word reasonable versus low. Okay, so we talked about the background of being a fiduciary and the regulation and how this isn't about disclosure, this is about reasonableness. Let's talk about the ways you determine fee reasonableness. Fee reasonableness is no different than any other project. And a good mental model for determining how a project should be run is looking at scope and time and budget. So on the scope side, what are the fees that are being paid? What's the investment performance? What are the sponsor services that I'm receiving? What are the participant services? Again, those are the value side of the equation. You can put fiduciary status in there as well. And then the time is the time to complete the project, and the budget is what are you paying out of pocket as well as the soft dollar cost that you're paying. So there's a lot of different ways to look at fee reasonableness. As you look at it, the choice that you decide to follow, and Pensionmark will help figure out what's the right method to use for you. It's basically considering what's the balance between scope, time, and budget. Another critical component to determining fee reasonableness, I think, that you should consider is what's the data that's being used. You have to use the right data. I can never imagine a investment review being put into a file that was knowingly wrong, that was knowingly inaccurate, that knowingly made bad comparisons. So it's really critical that you use the right data. Secondly, you have to build an apples-to-apples comparison group. When you benchmark plans in this industry, if you've been around for a while, you realize that pricing is different for $2 million plans versus $20 million plans versus $200 million plans versus $2 billion plans. The larger the plan is, the better the fee break occurs because you get to amortize fixed costs over a larger base of assets or participants. So it's really important that you build an apples-to-apples comparison group of similar plans. Thirdly, you have to collect and examine fees by provider. It's important that you know that fees at the total plan level are not what counts at the provider level, and you have to determine the value add by provider as well. Again, remember, this is about reasonableness, not low, and therefore you have to look at value as well as fees. One thing that we've learned in fiduciary benchmarks is, we pretty much learned that the data not to use is anything that's based on the Form 5500. The Form 5500 is designed to do many things, but it's really a very, very difficult tool to be used for benchmarking. And in fact, the GAO in a one-page executive summary on the 5500 stated at the very bottom, the 5500 in current form may not be helpful to plan sponsors or others. And the reason for that is there's a tremendous amount of flexibility built into the way that a Form 5500 can be completed by a service provider. And so since there's so much flexibility in the reporting, it's hard to get apples-to-apples comparisons. So for example, we've seen some cases providers using the 5500 have been off by 85 to 285 basis points of actual data we have in our database. We tested 1,000 cases of participation rates from Form 5500 data, 50% of them were off by 10% or more. And there are neurological conclusions that could be reached on other items like salary deferrals or employer contributions because you don't have compensation data to normalize things. It's sort of a complicated concept there, but the bottom line is the 5500 contains no service, support, or success measure information. It can be critical in assessing fee reasonableness, and it really doesn't recognize the costs that drive service providers. So if Pensionmark for a client is doing quarterly meetings versus annual meetings, that's obviously more expensive. That requires more time, more labor. That has to be paid for accordingly. And the 5500 doesn't recognize those costs. So it's really not a tool designed for that. Next. Come on, computer. We're waiting. Sorry. Trying to get to the next page here. Oh, there we go. Oops. Sorry. Okay, so the data should really come from the source. It should come from, the record keepers and service providers for the plan. Whether it's Pensionmark, whether it's T. Rowe Price or Prudential, M&I, or Fidelity, whoever it is. That way you know your data is current, you know that it's accurate, you know that it's consistent. So in terms of the source, it's important that data come from the source who would actually equal the 482 disclosures in many cases. Let's talk about how to build an apples-to-apples comparison group. You want to start with current data. You know, you generally want to benchmark against data points that are 10 years old or are not really reflective of market pricing. You want to make sure you have a great array of both record keepers and plans for similar comparisons. So we use something called a 25-10-2 rule, where we're looking for at least 25 similar plans from 10 different record keepers and 2 different business models. So the best, you know, you got to make sure the data is current as you build your benchmark group. You've got to make sure that you've got enough diversity in the benchmark group. So if, for example, you went on to Edmunds.com to look at luxury cars, you see an Infiniti next to a Lexus, next to a Mercedes, next to a BMW, et cetera, et cetera, et cetera. The third point is you want to look at the economic factors, other economic factors that drive the benchmark group. I'll give you one that a lot of people overlook in the industry is you absolutely have to look at the average account balance. A plan that has an average account balance of $200,000 versus one that's $20,000 is a very, very different cost factor to a record keeper because the revenue side is so much higher with the $200,000 average account balance. Economic factors like the number of locations served by an advisor, the number of meetings served by an advisor. Those economic factors also make a difference as well. And then when you have current data that has a good diversity to it that recognizes economic factors, you optimize that by making sure that you mitigate the influence that any one individual might, any one service provider might have on the group. So for example, when you pull up Edmunds.com, you don't see more BMW listings because they sell 3 times as many cars as Infiniti. So you build a benchmark group, you want to make sure you've got a definite, different number of providers that you see, so you get a profile of an optimized group. Next. See if it's working. There we go. So once you've got the data right, you've got the benchmark group right, then you've got to look at the fees and make sure that you're looking at all the fees that are being paid. And, you know, without going into all the words on the page, but you want to make sure you understand where's the money coming from for the fees. So is it coming from plan assets, or is it being paid by participants, or is it being paid by the plan sponsor? So because different plans pay fees in different ways, but you want to make sure, like the spaghetti sauce commercial, that it's all in there. So you want to look at the source of the fees. And then you want to take those fees and break it down by service provider, because again, that's the requirement by the law. What's the record keeper getting? What's the TPA getting, the advisor or the money manager? And you know, the focus should be on understanding each building block of the fees, and that you've vetted all of them and allocated them among the service providers. And finally, you've got to make sure that you normalize the data. You know, that you're looking at it at the plan level, at the service provider level. You break it down a little bit further by the investment option level. You want to keep making sure that you give the fiduciaries the actionable intelligence they need when you benchmark it to make sure that they know what to do. Next. From a value component, when you're benchmarking a plan and trying to determine fee reasonableness, you know, you're really trying to make sure that you're being fair to all 3 entities, that you're being fair to the plan sponsor, that, you know, that the services that are being provided to them to help them fulfill their fiduciary duty are being reflected. You want to be fair to participants, and whether or not you're helping them in retirement readiness. And again, you want to be fair to the service providers that are actually doing the work for you, that you're not asking them to do more for less. You know, when people have problems with benchmarking systems, whatever they might be, they always get concerned when they feel something's unfair. And as we think about this issue, we think you've got to be fair to everybody. You've got to be fair to the sponsor who has the fiduciary duty to run the plan. Are they getting what they deserve? Are participants being helped towards retirement? But also, are you being fair to your service providers? Another critical scope should be independence. You know, a number of the fee lawsuits have resulted in settlements that are multi-millions of dollars. And a number of the settlements have included a requirement that an independent exercise be conducted. So, General Dynamics was $15.2 million, Caterpillar 16.5, Bechtel 18.5. Walmart was just done with where theirs was $13.5 million. And a requirement that comes out of these is, hey, look, is there an independent exercise being done? You can't actually ask your service providers whether or not their own fees are reasonable. You need somebody else other than, the fox in the hen house telling you how many chickens are there. Benchmarking alternatives, there's many in the marketplace. We are just one, and you have to choose the right tool at the right time. You can ask your provider for data. You might have a little bit of an issue with an independent component there, but there are some providers that actually put independent data in the things that they give their clients. You can use 5,500 providers like Brightscope or Judy Diamond or Advisor Lab. There's a number of folks that do that. You can use the 401k averages. You can use fiduciary benchmarks, which is not as much effort as just pulling something that's a little more off the shelf. And then you can also do a short RFI or a custom RFP. There are a number of different ways that you can benchmark fees and value to protect yourself as a fiduciary. And so before we end, I think what's important is to understand as you look at any one of these alternatives, you want to make sure that it's independent. You want to make sure that the data is accurate. You want to understand how the benchmark groups are being built, and how do they do by service provider, and how do they make sure the services to plan sponsors are fair, and are they looking at retirement readiness for participants, and how fair to the service providers too, and how much time is it going to take, and how much cost is it going to be out of pocket and internal cost. So there's a number of different alternatives, and it's best to sort of use this matrix to understand what you're getting for what you're paying. And in closing, it's an exciting time in our industry. This transparency and disclosure will be good. It will be good. It will be healthy. It will be cleansing. And most service providers are overwhelmingly appreciative and supportive of this if they're good at what they do. And if they're not, they're a little more wary. Someone like Pensionmark, just by the sheer fact that they're holding this webinar and offering this information on their upcoming site for all their clients to be educated upon, shows that they're serious about making sure that all the fees being paid from the plan are reasonable. Good providers will thrive under this environment. They will not suffer. And in fact, that's been true in other industries in the past. So with that, I'll open it up for any questions. Devin?
Thank you, Tom, so much for your time. I think you did such a great job. You didn't have any questions come through. But I did want to say a couple of things just on behalf of Pensionmark, because this seminar is really open to our clients. The issue or the discussion of the fee disclosure, the discussion on fiduciary requirements, who's a fiduciary, et cetera, those things are probably not new to a lot of you, especially those that have continued to attend our fiduciary seminar on an annual basis and through our annual meetings. But what is going to be new and something we've been working on in the background over the past year is how we're going to formalize our process in documenting for you reasonableness in terms of the fees. So as all of you recall, in every annual meeting you have with us on your plan, we go over the fees, and we do use a variety of different tools to benchmark your plan and make sure your fees are reasonable. But what we've been working on, again, in the background is how we're actually going to help you document that. So we're going to be delivering some new checklists, some new disclosure documents that will help you on the topic of fee disclosure and reasonableness. We have already, 2 years prior to the fee disclosure coming out, delivered our disclosure to you in terms of our advisory agreement. So if anyone has any questions on that, or you want to take a look at your advisory agreement, again, work with your relationship manager. But we're really excited to be rolling out some of these new tools. Again, our main focus is to try to get ahead of these things for you as a client, make sure you're documenting everything, and that at the end of the day you can rest assured that you have peace of mind when it comes to your plan. So that being said, I don't see any other questions that have come through. I want to thank Tom. I want to thank Putnam and Goldman for helping us to put this presentation together, and of course everybody who's been listening and participating in the webinar today. Thank you very much.
Thank you.